The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint, and welcome to our weekly market deep dive for April 12th, 2021. Last week was an interesting week with some quiet markets, but yet some very important action technically. Starting with commodities and the dollar, you can see that the dollar, or the DXY index, actually found important resistance right at its 40-week moving average. These are natural areas for markets to find support and resistance. And the combination of this moving average, the MACD histogram downtick or momentum, taken together suggests that the dollar may be running out of gas over the intermediate term. On the flip side, you can look at the euro, which should trade opposite the dollar, and it did find support near its 40-week moving average. So again, some short-term developments that could turn into long-term developments, meaning the downtrend being extended in the dollar. That has been what's been going on. And if you step back and look at commodities, that downtrend in the dollar has helped the reflation trade. The Bloomberg Commodity Index is in the center pane near the bottom, and you can see commodities as an asset class have been strong for over a year. With this bullish rally, you can see the market pulling back over the last 6 to 8 weeks in a very nice orderly fashion, which again should be consolidation and a further uptrend to follow. Two commodities that we like to watch closely are crude oil and copper, and both in the top right of the screen look like they're seeing orderly consolidation patterns within an uptrend. Looking a little more deeply at both Brent crude and gold, you can see a similar picture on Brent crude. You've seen strength since the COVID bottom last March, and with that strength, you've been able to get through some very important levels technically. Specifically the high 50s, $59, $60 area on Brent. While we did surge all the way up to 70, the market is now pulling back and consolidating those gains in a healthy, orderly manner. Gold, on the other hand, are seeing a few more headwinds. While spreads were higher on the week, as you can see with this green circle, there is a pretty big divergence between the 5-year break-even less the 5-year yield and the 10-year break-even and the 10-year yield in yellow. The point being, the last time those two diverged was back in 2013, which was right at the top in the shiny yellow metal. Looking into global yields, this is where it really was a quiet week last week. The United States yield curve is on the left-hand side of the pane, and you can see that over the last 6 months, the yield curve has steepened nicely, which is again another sign of economic growth behind the scenes. Globally, if you look at the chart on the right, particularly the green circle, which goes back a year, or the green rectangle, you can see that the move higher in interest rates was led or foreshadowed nicely by the 10-year US break-even. That 10-year US break-even bottomed last March and has been strong ever since. It took a couple of months for the US 10-year to get the memo and follow the 10-year break-even higher. It took a couple more quarters for the British bond to get the memo and follow our yields higher. And you're seeing the similar situation in German yields. So again, in general, global yields have been strong over the last 6 to 12 months, while last week, a pretty mixed and quiet week. Looking a little more tactically at our bond slide, which we like to show every week, again, you can see the very quiet week on the daily chart of the 10-year in the top left. Not much going on, potential little short-term bottom, but again, the 140 area, as you can see on both the monthly chart and the weekly chart, was a very important area to get through. So it's natural to find resistance at a round number like 1.75% or 1 3/4, and for the market to digest its gains over the next couple of weeks and months. Credit spreads remain very positive in the fact that they're low and tight. meaning the premium paid on high yielding and investment grade bonds over treasuries, is not that much. You're really not being paid that much to take the extra risk, which is the market telling you there's not that much extra risk because the economy is healthy. If you look at the move last week, both the the triple C spread and the high yield spread scored new cycle lows at 5.16 and 329 respectively. So again, well off their highs of an 18% advantage over treasuries during the COVID bottom, down to 5, and for high yield from over 10 down to just over 3. Investment grade spreads remain low and actually already hit an all-time low a couple of months ago at just 1.06% above the 10-year treasury. Taking a long-term look at stocks, we like to look at the value line index. And you can see that the value line was up about 85 basis points last week. Another nice performance by the value line. And again, the US stock market in general. What's notable are these green rectangles, which is the first surge in market internals after a major market low. Again, we use red vertical lines and green vertical lines to measure when the percentage of stocks above their 40-week average is either above 40% or below 40%, which is what we use to define bull and bear markets. It's a lagging indicator for sure, but it does a great job of keeping you on the right side of the major trend. If you look at the magenta box, however, though, that is when the percentage of stocks above their 40-week moving average is above 80%. And what's unique and notable about this market cycle is how long this percentage has remained above 80. It is quite strong. And again, that is the characteristic of this market. We have not backed off over the past couple of months, and that indicator has remained above 80 since the value line was well below 8,000 and in the low 7,000 area. Looking at stocks a little more tactically, we have daily charts on the left, weekly in the center, and weekly on the right of some different indices. Our point here being is you can see the strong, literally straight up week last week in the S&P 500 in the top left. The Friday before last was the first close in the market above that magic 4,000 level. This week, or last Friday, we closed above 4,100 for the first time, and the numbers really are starting to fall. That being said, leadership has yet to confirm the new high, meaning the number of stocks making new 52-week highs, as has the NASDAQ. The NASDAQ has not exceeded its high from February, while the S&P certainly has. I do think this is a short-term phenomenon, however, because if you look at the weekly charts down the center of the pane, you can see a lot of those internals just starting to uptick. For example, breadth, or the advanced decline line, or the number of stocks advancing, is at a new high, so that has clearly upticked. The MACD histogram flashed a buy signal last week, so it is clearly upticking. And you can see the percentage of stocks above their 50-day, a little more short-term average of the market, is just starting to break its downtrend. So again, the bulls have the ball over the short to intermediate term. The question is, how far can they move it down the field? The indicators, or the indices on the right-hand side are confirming it. You can see the Dow Industrials and the Dow Transports at new high territory, while the mid caps and small caps have been lagging. It's the small caps that really led the rally the first quarter of the year and the back half of last year, the last quarter of 2020. And to see them pause is not unexpected and not bad news. They are just consolidating their gains, again, in a healthy, orderly manner. The real risk to the market right now, or the primary risk in our view, is one of sentiment. The next slide is of sentiment from my good friend Chris Verone of Strategas. And Chris notes that there are several indicators that represent sentiment that are literally running hot, or in the top 90th and 95th percentile. If you look at flows into some of the ETFs, not that bad. S&P 500 futures positioning, not that bad. But if you look at some of the more traditional indicators like the II bull to bear ratio, the percent bullish, the AAII 10-day put call, 20-day put call, all these indices or indicators are either in the 90th and or 95th percentile of their readings. So with 4, arguably 5 indicators in high ground or hot territory, sentiment is a worry of the market right now. Looking at the sectors, and this is where it gets interesting, meaning last week's action was interesting and I think a bit revealing. You can really see that the FANG stocks got the memo. And by FANGs, we mean Facebook, Amazon, Apple, Netflix, Google, and Microsoft. Those stocks are affectionately known as the FANGs or the FANG MAs. And if you look at the sector action with the technology sector leading the market higher, discretionary leading the market higher, and consumer services leading, being the top 3. Also with the NASDAQ composite, the strongest index of the batch. And finally, within the style boxes, large growth and large value were up on the week, while small value and small growth were down. And clearly, large growth did the best. So it's clear the FANGs got the memo and they were the real drivers of the gains last week. Taking a closer look at them and looking at them each individually, you can see what we mean. Apple surged off its 40-week average at 120. Microsoft surged as well to a new all-time high. In fact, 3 of the stocks hit a new all-time high. Google right below it, breaking out of a bullish flag. Amazon held the 3,000 area, not quite in an all-time high yet, but certainly a nice move, and it looks like it's headed there. Facebook scored an all-time high after going sideways for 3 quarters. The bottom scale on this chart has each tick mark as a quarter. And again, while the small caps were driving the market higher the 4th quarter of last year and the 1st quarter of this year, you can see Facebook, Amazon, Netflix, arguably Microsoft, all really just went sideways and marked time or consolidated their gains off the COVID lows. So again, not bad action, just a little bit of a passing of the baton to the small and mid cap stocks. Well, last week's action, where the FANG stocks got the memo, was good, healthy action in that they are continuing to move higher and not diverging from the overall market. If you look at volatility within the market last week, again, you can see it was a very quiet week. We have volatility surfaces in the S&P from 4.9 and 4.1, and the change between the two is really minor, with the exception of the little 1 month, 120 moneyness tip here on the edge. So not much change in the vol surfaces from week to week. Additionally, the volatility index itself, or the VIX, is trading below 20, which again is not a warning sign for stocks, if anything, too complacent. And the VIX forward curve is not moving at all. So again, no warning signs with a spike in VIX as of last week. If you look at some of the more interesting action within the sectors, you can see the Russell, the NASDAQ, and the S&P 500 across the top. The green line is up vol skew, and the red line put vol skew. So when one is higher, it shows the market has a preference for that direction. So the Russell, the NASDAQ both show buyers are in control. Nobody's really worried about the market. Maybe a little bit of an uptick in down volatility skew in the NASDAQ. But what was interesting last week is the pretty significant increase in down volatility skew on the S&P 500. That's not surprising, given we're coming into earnings season here, a little bit bigger move than previous earnings seasons. But again, it shows people are buying both puts and calls ahead of earnings season. So again, maybe that complacent sentiment may be getting ready to give way to a little bit of a downdraft or consolidation based on skew analysis. Regarding the overseas markets, the main point I want to show on this slide are the 2 charts on the top right. These are the very popular Chinese ETFs, the MCHI ETF, as well as the A-shares ETF. Remember, China is the 2nd largest economy in the world, well ahead of Japan now, about 3 times the size of Japan, still behind the United States. But being such a strong market and one that was so impacted by COVID, it was important to watch how these markets traded last summer, and they were among the first markets to recover and to recover the strongest, going to new all-time highs, or not all-time highs, but breaking out to new 52-week highs in the summer months. So again, because they were so strong so early and led the way higher, it's important to note and watch how they handle this first significant pullback that they've seen since those lows. In both cases, these ETFs, which represent, again, 85% of all Chinese market cap and then 2/3 of all onshore market cap, are holding their 40-week moving averages like a champ. Should those areas fall, it would be one of the first warning signs we would see for our markets. We're not expecting it, but again, it's good news so far that these areas are holding. Finally, we'd like to take one quick look at one of our favorite COVID slides, as we do each week. This is information we find from First Trust, and every week they do a great job of summarizing some COVID statistics. The top chart on the left by the letter A shows the large surge in both cases and deaths toward the first part of the year, which have dropped dramatically. We're off 2/3 and 3/4 in some of these numbers. And again, the COVID surge does not appear to be coming according to these 7-day moving averages. If you look at B, there was a study published by the CDC recently that said the chances of surface transmission of COVID are less than 1 in 10,000, which is good news for all of us who are worried about touching doorknobs. If you look at C, both on the left and on the right, you can see that the number of doses given of vaccines is rising dramatically and steadily. And the percentage of Americans 65 to 74 receiving at least one dose of the vaccine is around 70%. And for those over 75 years of age, it's 75%. Finally, and this is probably the most interesting thing I saw on here, and it's not the chart on the bottom right, but it's the shaded box above the chart. This is a new study that is quoted from the University of Chicago Medical School that says having a vitamin D level above the traditionally considered sufficient likely or most likely lower the risk of infections, especially in Black Americans. So in summary, last week was a quiet week for the markets, but there were some important moves technically. One of them was the US dollar, which is struggling at its 40-week moving average. Again, a resumption in the downtrend in the dollar would certainly help that reflation trade going forward. Yields globally continue to rise strongly. It was a quiet week last week, but the last 6 to 12 months, depending on where in the world you're looking, has seen a strong rise in interest rates, government bonds, and that's also confirmation that there is solid economic growth out there. Credit spreads remain low and a tailwind for stocks, and actually hit cycle lows last week. Hitting a cycle high this week or last week was the S&P 500, which traded up to 4129, as you can see in the top center chart. Market internals remain strong and it continues to look like a bull market, but we would like to see the daily charts catch up over the next week or two. Sentiment remains the main risk to the market in our view. And if you look at the right-hand side, you can see several of our risk measures, which again are scoring patterns of higher highs and higher lows. Whether it's copper, the copper to gold ratio, the ratio of Dow transportation stocks to Dow utility stocks, the yield curve as measured by the 10-year to 3-month spread, or the ratio of consumer discretionary stocks to consumer staple stocks, either equal weighted or market cap weighted. Finally, overseas markets remain in a healthy uptrend there as well. They appear to have been pulling back over the past couple of weeks, most notably in China, where so far they're holding a very, very important area of support. Again, I am Mike Hurley. Thank you for your time and attending our deep market dive for April 12th, 2021. If you have any questions on our brief, feel free to reach out to us directly or contact one of your sales reps. Thank you, and we'll see you next week.